As the U.S. and China continue their fierce trade rivalry, the question remains, who is truly paying the price? The forthcoming changes are expected to have a profound impact on American households. Amid escalating trade tensions, China has officially imposed a ban on domestic airlines purchasing aircraft from Boeing, including the 737 MAX and 747 models. This move directly affects major airlines such as Air China, China Eastern, and China Southern, who have been significant customers for Boeing. Boeing, currently grappling with both technical and financial challenges, reported a loss of $11.8 billion in 2024, and its stock has dropped by 12% since the start of 2025. Boeing is also one of the largest employers in the U.S., providing direct and indirect jobs for tens of thousands of workers in fields such as supply chains, maintenance, logistics, and services. Losing the Chinese market, which accounts for more than 15% of Boeing's international sales, may force the company to scale back production, leading to potential layoffs or reduced working hours. China represents about 15% of the global commercial aviation market and is projected to increase this share to 20% within the next 15 years. In addition to halting aircraft imports, China has also suspended the import of aviation parts from American companies. This will have a ripple effect on thousands of suppliers, such as GE and Spirit AeroSystems, impacting factories across various U.S. states, including Washington, South Carolina, Kansas, and Missouri, as Boeing faces a decline in revenue. Tax revenue from businesses in these states is expected to drop, which could lead to cuts in public spending, directly affecting social services, education, and healthcare that American citizens rely on. On April 11, 2025, China officially imposed a 125% tariff on all goods imported from the U.S., including agricultural, industrial, and pharmaceutical products. This move has significant implications for U.S. businesses, particularly in the pharmaceutical sector. Companies such as Eli Lilly and GSK are facing higher costs for their cancer and diabetes treatments made in the U.S., with limited access to the Chinese market. This increase in costs may make it more difficult for U.S. companies to maintain affordable prices domestically, thus impacting American healthcare costs. Along with the tariffs, China has suspended exports of rare earth materials and magnets, critical components in the production of electric vehicles, chips, semiconductors, aviation, and defense. This disruption will likely drive up the cost of products such as electric cars, laptops, and smartphones. U.S. consumers will either face higher prices or longer wait times for these items. Agricultural exports such as soybeans, beef, and grains are also heavily taxed, leading to significant losses for American farmers. Many could see their income decline, lose their farms, or be forced to apply for government subsidies. Following the suspension of Boeing aircraft imports, China has deepened its partnership with Airbus. Airbus now operates an assembly plant for the A320 series in Tianjin and is expanding its production line, with plans to increase output to 75 aircraft per month. By 2026, China has already placed an order for 150 A320 neo aircraft and 10 A350s from Airbus. China is also heavily investing in COMAC, Commercial Aircraft Corporation of China, a domestic aircraft manufacturer. COMAC has increased its production of the C919 aircraft from 50 to 75 per year, with a target of 200 units annually by 2029. In addition to strengthening its aviation industry, China is pushing for increased use of the Chinese yuan, CNY, and the euro in international trade, particularly in the aviation sector. As more nations shift to trading in either the euro or the yuan, demand for the U.S. dollar decreases, weakening the dollar. This will lead to higher import costs for Americans purchasing goods like clothing, electronics, and cars, thereby driving up domestic prices. China is quietly redrawing the global tech map, surpassing Western powers in key areas. As the 21st century tech race intensifies, is the U.S. falling behind? As of March 2025, China is asserting its dominance in global technology, with a growing presence in American daily life. TikTok has over 170 million users in the U.S., while CapCut, Shein, and Temu frequently rank among the top 10 most downloaded apps in the U.S. and other Western nations. American consumers, especially the younger generation, now interact with Chinese goods and content every day, raising concerns about data privacy, content influence, and tech dependence. In the electric vehicle sector, China sold nearly 9 million EVs in 2024, triple the U.S. total, with BYD surpassing Tesla in production volume. This has pushed American automakers to accelerate innovation amid growing competitive pressure. China also controls 95% of the solar energy supply chain and is projected to generate 60% of global renewable energy by 2028. This reliance on Chinese equipment has triggered alarms over energy security. In the drone market, DJI commands 70% of global share, and 3 of the world's top 10 drone manufacturers are Chinese. U.S. officials have raised national security concerns about potential data collection by these devices. In cutting-edge fields, China now leads the world in AI patent filings and quantum computing research, according to Nature Index 2024. In response, Washington is ramping up investments in AI and talent retention to safeguard its technological edge. China's tech rise isn't a fluke. It's the result of a deliberate strategy. Launched in 2015, the Made in China 2025 plan outlined over 250 specific goals to shift China away from its role as the world's factory. By 2023, 86% of those targets had been met, with sectors like EVs and renewable energy outperforming expectations. China has invested more than $627 billion in R&D and plans to reach $1.5 trillion by 2027. Its state capitalist model, where the government plays a central role in industry, has proven effective. Meanwhile, American consumers are indirectly benefiting as competition forces the U.S. government to boost infrastructure and innovation spending. Amid China's rapid rise, the U.S. and its allies have imposed a wave of restrictions. These range from bans on advanced AI chip sales to accusations of cyber-enabled IP theft, especially in aerospace. As a result, Chinese firms have been forced to innovate using older chips to train their AI systems. In late 2023, while the world marveled at American AI models like OpenAI's GPT-4 and Google's Gemini, China quietly unveiled DeepSeek, an AI chatbot capable of competing directly with Western rivals. Despite being trained on outdated hardware, Washington responded quickly. The Biden administration rolled out a $500 billion AI infrastructure plan and accelerated the CHIPS Act to reduce reliance on Asian supply chains. For American workers, this could mean more high-tech jobs and stronger support for domestic innovation. Despite its progress, China still faces significant hurdles. In advanced chip manufacturing, it remains dependent on tech from ASML in the Netherlands and TSMC in Taiwan. New U.S. sanctions are making it even harder for China to access 5-nanometer and 3-nanometer chips, crucial for AI and premium smartphones. Meanwhile, some Chinese products, like TikTok, are at risk of being banned in the U.S. over national security concerns. The U.S. government is pushing new laws to regulate foreign digital platforms and protect user data. This raises a critical question for American consumers. Should they choose the convenience of Chinese tech or prioritize their privacy and national security? Tensions between the United States and Germany are rising over tariffs and U.S. bonds, adding uncertainty to global financial markets. Europe's move toward greater strategic autonomy and the potential repatriation of gold reserves may reshape the global economic landscape. German Economy Minister Robert Habeck expressed concern about how the U.S. calculates tariffs, especially in the pharmaceutical sector. He emphasized the need for both countries to consider mutual impacts when applying trade measures. Germany is one of the world's top pharmaceutical exporters, accounting for about 14 to 15% of global pharmaceutical exports in 2024, according to Eurostat. U.S. demand for European pharmaceuticals continues to grow, with average annual imports increasing around 6% from 2020 to 2024, according to Bloomberg. Recent U.S. bond auctions have seen lower participation, raising concerns that foreign investors, including those in Europe and Asia, may slow down purchases or reduce their holdings. Reports suggest Germany is considering moving 1,200 tons of gold, valued at approximately $124 billion, from the Federal Reserve in New York back to Germany. If carried out, the move would aim to strengthen national control over reserves amid global instability. Under President Biden, the U.S. economy and stock markets have shown stable growth, with some indexes reaching strong annual gains, Bloomberg Financial Times. In contrast, during Trump's term, U.S. market performance often lagged behind economies like Japan, Canada, the UK, Germany, and China. Biden has focused on rebuilding multilateral alliances, particularly NATO and ties with Europe, to support global stability. In contrast, the Trump administration took a different foreign policy approach, shifting traditional partnerships and cooperation strategies. Minister Habeck and other EU leaders stressed the importance of unity in external trade talks, urging member states to avoid individual country negotiations in order to protect the EU's long-term interests. The EU is expanding trade relations with major partners such as South Korea, Japan, India, and Indonesia, aiming to diversify markets and reduce dependence on any single economy. It is also considering joining the CPTPP trade pact as part of its broader global strategy. European leaders are prioritizing reduced reliance on external partners in key areas like defense and economic security. CDU leader Friedrich Merz highlighted the need for greater autonomy and the ability to respond to challenges independently and proactively. U.S. China tariff escalation sparks concerns of global economic fragmentation. Trade tensions between the U.S. and China are sharply intensifying, triggering price surges and shaking global financial markets. Is this just the beginning of a deeper economic split? Or could an unexpected turning point help avert a broader crisis? The trade friction between the U.S. and China has been ongoing since 2018-2019, when the U.S. first slapped high tariffs on Chinese goods. Beijing answered with a series of retaliatory moves. Now China's stepping it up, announcing tariffs up to 84% on U.S. imports. No, that hits hard, especially for soybeans, corn, beef, plus tech and machine parts. The U.S. fired back, hiking tariffs on Chinese goods to between 100% and 145%. That means electronics, textiles, auto parts, all getting way more expensive in the U.S. For American exporters, especially those dependent on China, these tariffs could mean serious trouble. We're talking disruptions, or even permanent market loss. Meanwhile, global stock markets, especially in the U.S. and Asia, are sliding. Why? Because investors are worried about supply chains breaking down and what this could mean for the future of global growth. According to estimates from the Peterson Institute for International Economics and various independent studies, elevated tariffs could cost American households an additional $3,000 to $5,000 annually, if maintained over time. Recent data from the U.S. Bureau of Labor Statistics, the BLS, indicates that inflation in 2023 ranged from 4% to 6%, based on the Annual Consumer Price Index, the CPI. Additional tariffs could further exacerbate consumer price increases, especially for imported goods such as electronics, clothing, and home appliances. Efforts to shift supply chains away from China to alternative markets like Vietnam or India could raise production costs by approximately 10%. For products requiring specialized components or technology, cost increases could reach up to 40%. If prices continue to rise, purchasing power, especially among middle and lower income households, may be significantly impacted. Amid ongoing trade tensions, yields on U.S. Treasury bonds have surged, with the 30-year yield nearing 5% and the 10-year yield approaching 4.5%. According to data from the U.S. Treasury and Bloomberg, 10-year yields fluctuated between 3.5% and 4.3% in the second half of 2023, showing substantial volatility compared to previous periods of relative stability. Concerns over a prolonged tariff conflict and a broader economic slowdown have led institutional investors and funds to restructure their portfolios. This shift has reduced demand for government bonds. In some cases, market turbulence has triggered margin calls, forcing hedge funds to sell off positions, adding to the chain reaction across global financial markets. China has reportedly reduced its holdings of U.S. Treasury securities to below $750 billion. Despite still being one of America's largest foreign creditors in 2023, China's holdings have shown a steady downward trend in recent months. According to data from the U.S. Treasury, trade-related tensions may be incentivizing Beijing to gradually scale back its exposure to U.S.-denominated assets as a way to reduce economic dependency. A sell-off of treasuries could also serve as a hedge against inflation, against currency volatility, or to strengthen domestic liquidity. Moves like this often shape the strategies of global investment funds and corporations and can increase volatility in both equity and foreign exchange markets. The U.S. is reportedly working to strengthen trade ties with key strategic partners like Japan, India, and the European Union in an effort to counterbalance China's growing economic influence. According to the World Trade Organization, the WTO, these alliances already represent a significant share of global trade. But differences in rules of origin, technical standards, and national policy goals are making it difficult to establish unified trade strategies. Tighter trade restrictions on China could eventually lead to a true decoupling of global supply chains, splitting the world into two distinct trade blocs. The G7's partial economic isolation of Russia showed us what that looks like. Increased costs, more risk, and ripple effects far beyond just the countries involved. Companies around the world may be forced to restructure supply networks, absorb higher operating costs, and sacrifice flexibility, all in an environment that's becoming more uncertain and more fragmented. In a strategic shift, the United States has temporarily suspended additional tariffs on over 75 countries, while intensifying its trade stance toward China. What lies behind President Trump's recalibrated trade approach? On April 9, 2025, President Donald Trump announced a 90-day suspension of new tariffs for most trading partners, excluding China. The move aims to create a window for constructive trade discussions. At the same time, import tariffs on Chinese goods have been raised to 125%. According to President Trump, the measure targets countries that have responded with retaliatory actions. In contrast, Nations that OPT for dialogue will benefit from the temporary freeze. Markets responded positively to the announcement, with the S&P 500 climbing 9.5%, its strongest performance in years. Financial analysts view this as a sign that the U.S. is seeking a balance between applying pressure and encouraging diplomatic engagement in international trade relations. In his April 9th address, President Trump emphasized China's role as the U.S.'s largest trading partner, noting the significant trade imbalance. According to the Office of the U.S. Trade Representative, the U.S. imported approximately $438.9 billion in goods from China in 2024, while exporting around $143.5 billion, resulting in a goods trade deficit of $295.4 billion, an increase of 5.8% compared to 2023. Rising deficit. The continued growth in the trade deficit highlights a deepening imbalance in bilateral trade relations. Data discrepancies. There remains a gap between official figures from the U.S. and China. While the U.S. reports a $295 billion deficit, Chinese authorities have cited a $360 billion surplus. Sector impacts. Prolonged trade deficits may affect key U.S. industries, particularly those directly competing with Chinese imports, such as consumer electronics, textiles, and toys. President Trump noted that China has expressed interest in reaching a trade agreement, but appears uncertain about the path forward. They don't know how to get there, he remarked. According to Al Jazeera, U.S. trade officials indicated that Beijing has yet to formally pursue new negotiation rounds. That same day, the U.S. raised tariffs on Chinese goods to 125%, while extending a tariff freeze to other nations. In response, China convened emergency meetings and vowed to fight to the end, announcing plans to impose retaliatory tariffs on U.S. products. President Trump also stated that more than 75 countries have approached the U.S. to initiate discussions on trade, tariffs, and market access. These countries have refrained from retaliatory measures and expressed a willingness to pursue mutually beneficial solutions. Global reaction. The wide interest in engaging with the U.S. reflects international concern about the evolving American tariff policy and a shared desire to preserve stable trade relations. U.S. negotiation strategy. The Trump administration is expected to pursue individualized negotiations with each country, aiming for tailored bilateral agreements. Treasury Secretary Scott Bessent noted that each solution would be custom designed, and the president intends to play a direct role in the process. Concluding his remarks, President Trump expressed strong confidence in the nation's economic trajectory, predicting unprecedented breakthroughs within the next year. He asserted that the new trade policies would stimulate economic growth and generate jobs. Indeed, U.S. stock markets have shown notable recovery. However, some economists have raised concerns about the potential for an economic slowdown if tariffs remain in place. J.P. Morgan Chase & Co. has projected a risk of recession later this year, should current tariff strategies persist